Hi, this is Jeng, and today we're going to be talking about bridge lending. And I want to start with a picture. And if you look at the horizontal axis, you see the risk in the deal and the return on the vertical axis. And so as you go out further on the risk curve, Howard Marks had this in his book, and he talks about how the further you go out on the risk curve, obviously the higher return that you get, but then the volatility in that return changes as well. So I want you to keep this in mind as we go through bridge financing and why people do bridge loans. So we're going to talk about really two types of bridge loans. One is your recourse bank loan. Second is your non-recourse loans. And then we're going to go through some key terms, some case studies, and then really next steps for you if you're considering a bridge loan. So my background, I was actually born and raised in Houston, went to school in Austin at UT, and then have lived in DFW since 2006. And I was actually an underwriter at GE Capital where we did bridge loans um, for our own balance sheet. So we actually held commercial properties, so it was industrial, office, multifamily. We do 3 to 5 year bridge loans, non-recourse, anywhere from typically 10 million and up to $100 million bridge loans. And then I've moved over to Old Capital since 2015 and have really focused on multifamily, doing Fannie, Freddie, bridge loans all across the nation, and then also investing more specifically in Texas, sort of DFW, Austin, and San Antonio. So when you look at this chart, this really shows what options are available for multifamily loans, right? So you have the bank loan on the far left side, which is your recourse bank loan, which is what we're going to talk about first. And then you have in the middle is really for stabilized products. So Freddie Mac and Fannie Mae loans. And so the bank loan and the non-recourse bridge are really for when deals either don't qualify or the deal doesn't fit the business plan of the investor. And so we're going to talk about the bank loan, and then we're going to talk about the non-recourse bridge loan on the far right. And so before we jump into those specifically, I wanted to go through some themes for bridge. Number one, leverage magnifies, right? So if it's a good deal, it could become better, right? Because your leverage could be higher. You could get more interest only. You could have a shorter or lower prepay. But if COVID hits or your capex doesn't really work out as much as you thought, or there's a fire on the property, or something else comes up, it can become worse, right? Because you just do not have as big of a cushion. And so I put this picture on the right hand side, and it looks like it's an investor with a bunch of equity in that briefcase. And essentially, this bridge loan is going to take you to the other side. And the other side is you selling the property at a higher price, or it is a refinance. So you could be on in this side of the world, and it is really a refinance to Fannie or Freddie, like we saw on the previous chart. So, but as you see, there are some holes when you're taking that step. They're in this bridge loan over to the other side, and so we're going to explore some of those and how to mitigate those in the upcoming slides. And number two is everything is negotiable. And so whereas Fannie and Freddie, they send you your loan agreement and it's 120 pages and they basically say, all right, this is what it's going to be. And this has already been negotiated. Bridge loans typically on the recourse bank side, there's a little bit of negotiation. But then on the non-recourse side, there's a lot of negotiation on that piece of it. Lenders change constantly, right? So on the recourse bank side, they could have a big appetite for multifamily right now and self-storage right now, but for retail and hospitality, it's gone, right? So the lending can change consistently and constantly, and then their appetites can change. And so I pulled this chart. I think this is from the Federal Reserve, and it just talks about how banks are tightening across commercial real estate loans. And if you go back and look, in 2019, 2020, there really wasn't that much tightening of the banks. But then, boom, COVID hit, and basically all your recourse bank lenders, all your non-recourse bridge lenders, you couldn't find any of them. They were all gone. They had tightened significantly, and so their appetites can change very quickly. And if you are under contract at that time and they disappear, guess what? They are not, they might give you back the $50,000 that you put as a deposit, but they're not going to be able to close the loan. So that's a very important thing that lenders' appetites can change very quickly. When I was at GE, we essentially had some deals in the pipeline. And once Blackstone came in and essentially said, hey, we're going to buy you guys, we shut everything off. So it can change very quickly for market conditions or just company conditions. All right, so let's go over recourse bridge loans. So this is really your local bank lender. These guys are going to want the investor to be local. They typically want the property to be local. They really look at federal funds rate. So federal funds rate in 2019 was 2.4. It is essentially 0 to 0.25 right now in basis points. So 2021 loans on the recourse bank side are about 4 to 4.5%. You are signing recourse, right? So you are personally liable for this loan. So if they foreclose on it and there's still a deficit on the loan, then you can be held personally responsible. They can come after your assets, other assets. So they're going to look at the property, but then also, 50% of it's going to be on you. So what other assets do you have? What income, what tax returns can you prove that, what's sort of your global cash flow, whether you're, a doctor or attorney and you have a lot of cash flow coming in, this might be an option for you. So most people are using these on deals that are not stabilized. So it's not 90% occupied. The deal's sort of broken, right? And so they're going to use it for that. If it's under 5 million, that's where we see a lot of these loans, just because the pricing is a lot better than non-recourse under 5 million. And then they usually like to see a local sponsor. So they want you to sort of build a relationship with that bank and have a strong secondary source of income. So some advantages and disadvantages here. Most of the time, advantages, there's no minimum loan amount, right? So you can do a $500,000 recourse bank loan. You can lock the interest rate at the application so it doesn't float while you wait for the application to be done. It's relatively low closing costs, has a low prepayment. They can close very quickly, let's say 30 days, and then it can go up to 75% loan to cost. Disadvantage, obviously, number one, it's recourse, right? So you are on the hook. And a lot of people come into multifamily because they don't want to be on the hook personally. So that is number one on disadvantages. It typically is only 3 to 5 years, and it has a shorter amortization. So 20 to 25-year amortization versus 30 on Fannie and Freddie. So that's going to impact your cash flow. And then you have to actually show personal income on your tax return. So if you do not have a job, then it is going to be very difficult to qualify for a recourse bank loan. And they want you to have typically 10 to 25% post-close liquidity, compared to Fannie and Freddie usually is about 10%. So, U.S. citizenship, they're going to run all the standard checks on you, but these are sort of advantages and disadvantages on the recourse bank side. So I want to show you some examples of recourse bank loans that I've done. This was a deal down in Houston, about 95% occupied, under market rents. Is a 5-year loan term, 1-year IO, 25-year AM. As a first-time investor, so they wanted to get a deal done. And then once it was, I think, a couple years after they did the recourse bank loan, they were able to sell it, and they essentially had no prepayment penalty. This was another example here of a deal in Dallas, 75 units. You can see on the left-hand side, this fronted like a major street in Arlington, and the buyer had limited experience. So he really needed to do a lot of rehab to the property, $450,000 in rehab. The market rents were below, or the rents were below market. And so he really came in, spent a lot of money on the exterior, the interior of the property. And then when he sold this property, essentially 2 years later, the new buyer could come in and get a Fannie and Freddie loan because a lot of the rehab had been done. There was limited deferred maintenance, and they could get a non-recourse loan at that point. So that's when you're thinking about the bridge, you're thinking, okay, what's the exit, right? Because you're only 2 to 3 years away. So the exit's going to either be you sell the property or you refi the property into Fannie or Freddie. All right, so that was recourse bank loans. Let's go over to non-recourse bridge. So non-recourse bridge is typically 5 million and higher, right? So there's a lot more competition at 5 million and higher. If you get above 10 million, there's even more lenders in that space. And so what are they looking for? They're really looking at your experience and your rehab plan. So they're going to look at, have you done 2, 3, 4 deals? Have you taken them full cycle? Have you invested in this market? Can you show me some properties that you bought, that you rehab, that you improved the NOI? Like, show me that story. And then there, I mean, some people are going to look at in-place cash flow, but most of them are going to look at the stabilized value. So in year 2, year 3, what's my NOI compared to what it is now? And then what is the CapEx plan to get me there? So on larger loans, you're going to be 4 to 4.5% right now on non-recourse bridge. If it's a smaller loan, like you just have to do non-recourse for whatever reason, and it's, under 5 million, it's going to be more expensive. So 8 to 9% right now. And then these are going to typically be floating rates. So you'll need to buy an interest rate cap. All right, so this is pros and cons of non-recourse bridge loans. Let's start on the pros, right? So you can get up to 80% loan to cost. Some people are even going higher, 85% loan to cost right now. 1 to 3 years IO. So that's essentially full term, right? Because the loan term is typically 3 years, and then it's 30-year AM after that during the extensions. And then you have a low prepayment. That is by far, besides non-recourse and 80% loan to cost, low prepayment is why a lot of people are doing bridge loans, because if they sell, most indicators are only holding deals 3 to 5 years. So if you want to get out of the deal, you have a low prepayment and it's only 1%. And then if for whatever reason, let's say you're taking it down the Fannie road, and then occupancy drops to 85%, then you can't close, and you can bring in a bridge lender. They can come in and close the deal quickly, typically 30 to 45 days. Disadvantage is your rate is higher, right? So even if you do a $10 million or $15 million bridge loan, it's typically going to be 50 to 100 basis points higher. Right now, Fannie Mae, Freddie Mac, they're around 325, 3.5, and then bridge loans are 4 to 4.5. So you're about 75 to 100 basis points higher. They want the minimum loan amount to be above 5 million. And then it's going to cost you a little bit more. So the origination fee is going to be higher. The engineering, environmental appraisal are about the same, but legal is more expensive, right? So we said at the beginning, everything is negotiable. And one of those things is the loan agreement is negotiable. So that's going to cost you a higher legal bill on the lender side and the borrower side. And then you're going to need more experience, right? So if this is your first deal, second deal, this is probably not the right thing to do in terms of non-recourse bridge loans. You probably want to do a couple of deals full cycle, or have 3 or 4 deals in that market that you can prove. Some of the qualifications are a little bit lighter. So we said everything's negotiable, but in terms of net worth, in terms of liquidity, you can have a net worth of about 50% of the loan amount. And we've seen that work on bridge lenders. They typically aren't going to require your tax returns. They're going to be looking really at the property. And then if you do have, previous foreclosure, bankruptcy, maybe some litigation, bridge lenders can typically work around that. So they're not as strict as Fannie and Freddie. All right, here are some key terms, key items, I guess you could say, on the non-recourse bridge side that I want people to be aware of. So when you start a Fannie or Freddie loan, it's typically 10 to 20,000 to start, and that really gets your third parties going. On the bridge side, it's more expensive, right? So you're going to be looking probably, I've seen some as low as 30,000, some as high as 75,000, but 50 to 75,000 is typical, especially for a larger deal. Let's say 10 million and higher. That's really going to get all the lender legal and those items going. Your initial loan term is going to be 2 to 3 years, and then you're going to have 1 year extension subject to debt service hurdles, and then you're going to pay a fee every time you extend. Initial funding, so they're going to give you up to 80% of the purchase price, and then they'll also do a majority of the renovation funding. Sometimes it's 75%, sometimes it goes all the way up to 100%. Almost all of them are going to be floating interest rates. So you're going to have to buy an interest rate cap, which is going to be anywhere about $50,000 probably right now on, let's say, a $10 to $20 million deal. Origination fees are higher. You're going to get a lower exit, but your origination fee typically is higher. Closing 30 to 45 days. Loan docs, negotiable. Sometimes if it's above 20 million, you might have to get additional legal items like an opinion letter, And this is a bigger thing. So there's a thing called lockbox that a lot of bridge lenders require, and there's some that have to be in place at close if it's a lower debt service deal. Other times it's what's called a springing lockbox, and so what happens there is essentially the money goes into the lockbox, but then the next day it goes out back to you. As long as your debt service is above a certain amount. So typically in the loan agreement, there'll be something called a triggering event, and this will, if it goes above that, if it goes below a certain debt service after a certain time frame, then they're going to hit that trigger, and then the lockbox is going to spring into place. And so at that point, the loan agreement or the lender will dictate sort of what you can do with the money first, like pay all the expenses first, then all the money goes back to the lender. It could, pay down the loan. There's a lot of different things that I can do, but it's negotiable at that point. So just be aware that there could be a lockbox that springs out on these bridge loans. They're going to be looking at your operating budget, your rehab budget in a lot more detail than Fannie and Freddie, because they want to make sure that they can, when you exit the loan in year 3, that you can actually refi and sell this deal. And then they're going to spend a lot more time on your borrower experience and balance sheet. All right, so here's some non-recourse bridge loans that we've recently done. This one was a deal over in Garland, and it was an acquisition, 650,000 in rehab on, I think it was like 125 units. And you can see sort of how it looked before and then where they spent the money, right? So updated the exterior, improved the interiors, improved the occupancy. And, this property, probably traded for, they probably added about $3 or $4 million in value after that 650,000 in rehab. So this gave them the ability to do a higher leverage loan than they would have on Fannie and Freddie, and then also stay non-recourse, as some of the partners did not want to sign recourse on this particular loan. All right, this is the next one. And so this one, this one was even a bigger rehab, 15,000 a unit in rehab, and they were converting the chiller over to individual HVACs. So you can see that there's some window units in this property because I guess the chiller wasn't working all the time. And, we did 3-year loan, 3 years IO with one 12-month extension. You can see it has the interest reserve, springing lockbox, and then you have to buy an interest rate cap as well. So this interest reserve is one thing that we haven't talked about. So that is putting up money up front to make sure that you can pay debt service, right? So a lot of these deals, the first year, you're spending 15,000 a unit in rehab over the next 12 to 18 months. And a lot of times that involves, improving units, but your occupancy might dip from 95% to 85 or 80%. And so you're not going to have the cash flow to pay the debt service, especially at a higher loan to cost number, right? So that interest reserve is typically going to pay the debt service for the first 6 to 12 months sometimes. And then once the property has completed the rehab and you lease up the units, then that's when, at that point, you're hoping the property covers the debt service. This was another non-recourse bridge over in Irving that we did. So this one was 75% occupied. So it just couldn't qualify for Fannie or Freddie. The goal was to come in, do 75% loan to cost, interest reserve on this one because it couldn't cover the debt as is, and then had the same characteristics, interest rate cap, 1% prepay, and springing lockbox. This one was a non-recourse bridge. So this one, you could probably get about 75% on Fannie Mae, Freddie Mac, but they wanted a little bit higher leverage. So they went to 80% loan to cost. It had below market rent, so they could come in, do the CapEx, and they essentially raised about $2 million less in equity to get this deal done. So this, I want to show you an extreme example of where we had a deal and we had to price it for Fannie Mae and we had to price it for Bridge. And so it was about $27 million purchase. And then we laid out all sort of the uses. So your total uses on the deal was about 29 million. And we had bridge lenders come up to about 85% of that cost, right? So $25 million. So you would have to raise 4.6 million in equity. But obviously there's a lot more risk going that high in the leverage stack. There was higher cost to the deal compared to Fannie. Depending on the amount of equity, so Fannie was sizing to about $18 million on the loan. So the borrower would have to raise about 11 million. So depending on, how much equity you can raise, what your time frame for holding this deal is, and then how much risk you wanted to take. You could decide between these extremes, right? The bridge loan or the Fannie loan. And so we talked about at the very beginning, we showed you that picture of, okay, as you go further out in the risk curve, then your return should be higher because you're taking more risk, right? But really it's that volatility in returns, right? So to me, when I look at a chart, this is how I interpret it, is, if you take a Fannie, Freddie SBL loan and you have a 5, 7, 10-year term, to me, as long as you operate that property well and have the money to maintain it, then you will fall in this range, right? So this might be in today's market, let's say you're getting a 60, 70, 80% total return right here, right? And if things go really bad, there's a lot of issues on the property, you have to change management company, you might only get a 30 or 40% rate of return over the 10 years, right? But then if things go well, you operate the property well, cap rates compress a little bit more, you might be at 90 or 100% total return up here, right? And so that range, I think, is 30% to 100%, let's say on Fannie or Freddie. But then if you move up the risk curve, so if you go to a bridge loan and you have a shorter term, you have 3 years, your total return or your IRR, it could be 1, 2, 3, 4% if things go really bad, but it also could be 20, 25% IRR up here on the top side, right? So if you do everything right, you have a 1% prepay, then you could hit a higher return. I think if on the bridge side, if you could stay within this piece, that would be great. But if you go all the way up, so if you go to the highest leverage point and you're pushing everything on the shortest term, trying to do the most capex, you're probably out here, right? And so your risk has increased dramatically. And the return, there's no doubt that if you put less money into a deal in equity and you get the same exit, that your return is higher, right? But this little line right here, all the way at the bottom, if for whatever reason you get to year 3, you do the extension, you get to year 4, and you just can't sell the asset or refi the asset, then that is when you have a maturity. And at that point, you are at risk of losing equity of your limited partners. And so that's what I would make sure that you don't, if you do a bridge loan, don't take it all the way out on the curve on this picture. Here's some recent closings on my side. So the Azul was the non-recourse bridge loan that I recently completed. Some of these other ones were Fannie Mae assumptions. This was a Freddie Mac conventional. So whenever you can get a loan such as a Fannie or Freddie SBL and make it act like a bridge, that is probably the best of both worlds, right? So like on, let's say Wooded Creek, this was a 10-year loan term. I think we got 4 years IO, and that allowed, and you had a 1% prepay. So if you can get a Fannie or Freddie loan and get to 75, 80%, or even 70% leverage and have a lower prepay, that is the best of both worlds. It's not always going to work that way, right? Because sometimes your deal is going to be broken. Sometimes the occupancy is going to be low. Sometimes the rents are going to be too low to execute on that. But that is an option out there. Hazelwood was a Freddie SBL. Essentia was a Fannie Mae loan. Ridgemont, this was a Freddie SBL loan. And we set it up and they were able to raise the equity in a similar structure. Like we could have probably done a bridge loan, but they decided to raise the equity of the rehab, which was about 500,000-600,000, and that allowed them a little bit more flexibility and a safer exit. So they chose to be a little bit further left on the curve on that deal. Those also Wedgwood and Monterey were Fannie Mae loans as well. So we've done over 14,000 units since 2015. So let me know if you have any questions on any particular Fannie Mae loan. And then in terms of Old Capital and what I do, so I look at all these types of loans, right? So Fannie, Freddie, Bridge, CMBS, HUD, construction, and sort of figure out what the best type of loan for your particular deal is. And so whether it's quoting deals, walking deals, helping you win the deal, and then just sort of representing you throughout the process and then helping you sort of post close, right? So you're working on the acquisition for about 60 days, but then after that, you might own this deal for 3, 4, 5 years. So really helping you on asset management, loan servicing, those types of things is where we help you. I would say a lot more than most mortgage brokers and direct lenders out there. And we charge essentially the same. So we charge 1% of the loan amount at close. And so if you like this video, definitely subscribe to the YouTube channel, like the video, share the video with people who you think should be watching this type of content. And if you need help with a deal, whether you're a general partner, limited partner, you can send me T12 rent roll offering memorandum. I'm happy to review it. Or if you have an investment package and you just want me to look it over and let you know sort of what I think about the debt or the deal, happy to do that. So send me an email to discuss whether you're buying, selling, or refinancing your next multifamily deal. Thanks a lot.